afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 29th of September on Friday, and we have Gabriel Yap, Executive Chairman at GCP Global, as our guest today. Gabriel is a REIT specialist and a top 20 investor in many REITs on the SGX. Gabriel, welcome to the show.
My honor to be on the show.
Now, Gabriel, for a start, we're at the end of Q3 today, and we've experienced a sell-off over the last 2 months. What are your thoughts on this, and how did you feel the market looks like moving forward?
Well, for real estate investment trusts, it's not surprising because, for the last 19 months, since the Federal Reserve in the US raised interest rates firstly on 17th of March last year, there have been 11 series of interest rate increasing, bringing the Fed rate now to 5.25 to 5.5%. Essentially and historically, going back to 2004 to 6 comparison, as well as the last interest rate increase from 2015 to 2018 comparison, it's clear that real estate investment trusts will suffer. And this time around, they have suffered equally. The only difference is that this time around, the magnitude of the loss is huge. It's like down 23% as we speak today, as an index hit a low of 663 yesterday, testing the previous low of 662, which was seen on 21st of October last year.
So, Gabriel, then we've got people like Jamie Dimon, who obviously heads JP Morgan. It's a consumer-orientated bank saying that, hey, I think we need to be preparing for inflation rate or Fed fund rate at as high as 7%. How is that going to impact the REITs industry, particularly in the coming quarter?
Well, if that's the case, whether 7% or 8%, it is not something that the market have not seen before. Way back in the 70s, during the oil crisis, the federal funds rate will increase from as low as 6% to as high as 18% within a course of 1.5 years. So right now, the magnitude in terms of percentages are a little bit lower. But if we actually move up towards 7%, which is a possibility, then it will be disastrous for real estate investment trusts, not only just in Singapore, but across the world. And there are like 43 jurisdictions around the world with real estate investment trusts. In fact, it's not just real estate investment trusts that will be affected, but anything or any investment asset that is actually inversely correlated with higher interest rates will suffer.
So one of the key challenges around commercial real estate, not so much perhaps in Singapore, but in many markets, including the US, is the fact that demand is shifting. So a lot of, because of work from home or hybrid working solutions, you've had a shrinking in demand for commercial real estate. What are your thoughts on this, and how is this going to impact REITs, particularly Singapore REITs?
Right. I think, Brian, this actually has more to do with commercial office assets in the US. The big problem is that the big cities like Los Angeles, San Francisco, as well as actually New York, have actually given way in terms of the office occupancies. They have fallen down below 60% and has remained the case since COVID-19 completed. And right now, essentially, it's still very difficult for the landlords to, or rather the office companies to actually ask their employees to actually go back to the offices. So essentially, there's not hitting a very good rate. And this is one thing that's actually depressing the commercial office market. So if you look at the repricing, not only just in Singapore REITs, like the likes of Manulife, Prime REIT, these are the ones that hold commercial office assets from the US, but listed in Singapore. But if you look at the US REITs, like for example, Fernandez State Empire Building that owns office assets listed in the US, you can see that the same reprisal is actually happening. But at the same time also, one thing that is actually changing and forcing the impact of these changes is the fact that there's a huge migration from the likes of San Francisco, San Diego, downtown, Los Angeles downtown, towards what we call the Sun Belt area. So the likes of Arkansas, the likes of Houston actually benefiting from the inflow. So in the US right now, in the commercial office markets, there are really two particular sub-markets. One that is doing fairly well, from net migration. That is the Sunbelt areas like Arkansas, as well as actually your Houston, your San Antonio area, and the ones that are really bleak. That's a traditionally stronghold. That was San Francisco, Los Angeles, San Diego, New York, Connecticut.
Now, do you see any sort of shake-up then happening in the REITs market in Singapore, particularly in the light of all these dark clouds that are in the horizon?
Well, I certainly hope not many more so-called cessation of going concern, problems, because that which is actually a going concern problem has hit the likes of Tassing REIT in Singapore, EC World REIT, Manulife REIT. These are REITs that basically are what we term is actually on ICU, as in basically they're not getting the inflows that they're getting from their properties. And therefore they have actually stopped paying dividend to the shareholders. Now, Brian, going back to the premise of holding real estate investment trust, the whole idea is to buy into good, stable assets. These good, stable assets in turn generate cash flows, which the REIT manager uses to pay shareholders. And if in this case there has been given a jolt, not once, but twice, but three times, severely. And this culminated with huge losses in capital, something that we've warned about already in the last 5 years, amongst these three REITs. If this continues to permeate and populate, then you have a severe problem for real estate investment trusts in Singapore. Let's hope it doesn't become a systemic risk.
On that note, Gabriel, thank you very much for your insights. Thanks for coming on the show.
Thanks for having me, Brian.
Now, we've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out this interview on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.